If you're comfortable with that trading strategy, you don't hesitate. The principles remain the same. I've been bearish on crude oil. I want a relatively tight stop on that. China's economy is a pretty good barometer. We're seeing a lot of hope trades. What is it telling me about the market?
Welcome everyone to TradeStation and another edition of our Trader Interview Series. My name is Michael Burke. I'm Vice President of Client Trading here at TradeStation, and today we welcome futures trading expert Dan Gramza. Dan is president of Gramza Capital Management. He's a trader, author, educator, and sought-after speaker at industry events all over the world. Dan does a great monthly futures webinar for us here at TradeStation and offers a daily futures market commentary video on his website, dangramza.com. Dan, thanks so much for joining us today.
It's always a pleasure to be with you, Mike.
Dan, it's always great to chat with you about the markets, especially the futures markets. For our audience, tell us a little bit about your background and how you got involved in the markets.
I started with stock options. That's where my life began at the SIBO. And I was doing delta neutral spreads. What I realized was, first I thought, I don't have to worry about price. That's one of the features. But I did have to worry about a new variable, and that was volatility. So I thought I didn't eliminate variables, I changed the variables. So I thought I'm going to start studying price action to see if that can give me some clues. But as a market maker on the floor of an options exchange, market makers don't really care about price. They really care about using Greeks to manage their position. And so you build a position, or it gets built around a particular inventory of options that you may have. So the guys that did look at these charts and things like that were the guys across the street at the Chicago Board of Trade. So I went over there, and that started my journey into futures. And what I found there was some observations about the dynamics of a market. Because, Mike, what's fascinating there was that if you stood outside of bonds, during the trading hours of bonds, the whole world would have to come and participate while that market was open. And one of the things you could see is you could see the brokers' hands who stood on the top of these pits that they had at the exchange. And the brokers' hands tell you size, it tells you whether they want to buy or sell. It doesn't say who's doing it or anything like that, but it gives you an idea of the flow that's coming into the pit. So that order flow, I believe, is what we're looking at, the footprints of that when you and I look at a chart. From that point, I taught for a while at Market Logic School, where Pete Stottlemyre and Kevin Coy started that school, and that launched me into my career in terms of trading. I've always been independent. I haven't worked at a firm, but it's something personally that drives me on a personal basis. And so that's how my journey began.
So Dan, you talked about the way that you look at charts, and I know that you use candlesticks in a lot of your education. Can you talk a little bit about your philosophy on what candles represent and your approach to using them in your trading?
Sure. What happened to me, Mike, is that connectivity of what I think about being on the floor to the candles kind of came about in an indirect fashion. One of the things that was happening, to my surprise, is I started teaching at exchanges and at institutions different aspects of technical approaches, one of those being market profile. And I was teaching a course in Japan, in Tokyo, at Bank of America. And it was for customers of the bank. So Daiichi Bank, Sumitomo Bank, Industrial Bank of Japan. And they were all yield curve traders. And so a part of this course was to trade the markets live. Treasury bonds, 30-year treasury bonds. So we'd go out of the classroom and go into the dealing room, and I had identified some trades. We put the trades on, and I'm walking out. Everybody's left, and I'm walking out, and I'm with this gentleman, Kuno-san, and I see this fellow sitting at a table, a large table, drawing by hand candle chart. And I said to Kuno-san, I said, what are they? He goes, oh, those are Japanese candle charts. And I said, it's interesting. I've never seen that before. Now, what happened was, as they were kind enough to talk to me about it, what was going through my mind is, what does it represent? And what I found when I was teaching candles, when I came back, I was doing them by hand and Then the CME asked me to teach a course for floor traders, and then we opened it up to the general public, and some institutional traders came from Royal Bank of Canada, and I did things there for about 7 years for all their new hires. And then they told somebody in London who told somebody in Sweden and Helsinki. So that's how I've had this opportunity to circle the globe a couple times a year, working primarily with institutions and exchanges and universities on different trading approaches. But the core idea is this. One, as I mentioned, I do think a candle chart, for example, represents buying and selling behavior. Now, we could focus on names of candle patterns, which is about 80. And what I find is that when you teach that, who remembers number 1 by the time you get to number 80? And what should you do with them? How should you trade them? What I've done is I've melted down those ideas to just a few concepts. So now you and I can focus on the body of the candle. And if someone's not familiar with it, they draw a box between the open and close. And that's called the body. And if I have a close above the open, I think that body represents buyers. And if the close is below the open, I think that body represents sellers. And if the high and the low for that candle do not match the top and bottom of the body of the candle, that's represented by a vertical line called a shadow. Now, when it's at the highs, I think that represents selling. And when it's at the lows, I think it represents buying. The size of that shadow represents rejection. The size of the body gives us a feel for market acceptance. So if you look at it from that point of view, which is what I call behavioral Japanese candles, it gives us insights into the dynamics. And for me, it helps guide my decision process. It's what I use along with market profile principles, actually, in the daily video that I create on the markets. And I use it for stocks. I use it for options. I use it for futures, different applications, but the principles remain the same. What is it telling me about the market?
That's very interesting. And in fact, most of the webinars that you do for TradeStation, you usually spend a little bit of time talking about those patterns so that everybody's on the same page as you go through your charts.
Correct, because I want, hopefully, someone to leave with something they didn't know at the beginning of that webinar, or hopefully of today's conversation that you and I are having. You know, the whole intent, I've been very blessed by the markets. And if you can share an idea with someone else that helps them, I know that feeling. No matter who that person is, no matter how successful they are, everybody started at some point. And when they started at some point, I remember that feeling. All the time that I spent trying to think about the markets and how they functioned. And as I had success, I thought, gee, if I could share that information, then maybe somebody else could be helped as well. And that's my motivation really behind the teaching.
I think what you bring to the table is not only all of that experience, but a very unique way of looking at candles that makes it easy.
Yeah, hopefully. I mean, I have to tell you, I'm a simple guy, and that keeps it at the right level for me too.
So Dan, one of the things that I think is really incredible about what you do is your breadth of knowledge of the futures markets, not just the major markets, but all of the commodities, all the fundamentals of those markets. And I was just wondering, if you could talk a little bit about what does your day look like so that you keep up on all those markets?
Well, one, I've been doing it for a while, so that helps a little. And I use the fundamentals to give me a feel or an insight into what may be driving a market. But I should tell you, what I also use as the final criteria is the price action. So the fundamentals may be very bullish. I may be very bearish on a market. An example of that, and I got some emails from people who watched the videos, was crude oil. I've been bearish on crude oil. I don't think price action really supports some of the things that we're seeing, and I don't think the fundamentals support some of the things that we're seeing. We're seeing a lot of hope trades in crude oil, but we're not seeing the fundamental drivers there along with the technical. So sometimes they match up, sometimes they don't, but the real important criteria for me is the price action. So if I think about the fundamental aspects of it, I break it down into a few categories, Mike. I look at it from the point of view of expected fundamentals. In other words, we know there's an economic report coming out on the first Friday of the month, right? There's certain routines that we know come out on a regular basis, and that's why some financial markets have a certain cyclical characteristic to them, and I believe it's because of the way the fundamentals come out. We see that in equities as well, too. So that's one category. Another category I think about is what I call an anticipation fundamental. In other words, when you and I see the market moving, is the market moving because that's reality, or is the market moving because it's anticipating a future event? When the market reacts to the discussions between the United States and North Korea, is it reacting because something has happened? No. It's reacting because it's anticipating the possibility something could happen. An example where I live, which is in the Chicago area and in the Midwest, the first part of August is critical for soybeans. They have to have a certain amount of subsoil moisture to get the right number of blossoms and a certain size, and it tells you something about yield. Well, up until that point, they can be a weed. So let's imagine that you and I are looking at the weather report. In the middle of July, it says we're going to have drought conditions in August. Soybeans move up. Now, soybeans moved up because we don't have enough soybeans? No. They moved up because there's a possibility we may not have enough soybeans. So if you and I look at those higher prices for soybeans that just moved up, and August comes and we get all the rain and subsoil moisture that we needed, our soybean price is going to stay up there. And you and I would look at it and say, well, no, they're not, because that excuse has just been taken out of the market. So you see a market moving up on anticipation. That means then I want a relatively tight stop on that, because it could easily come down faster than it went going up. That's different than if you and I looked at fundamentals with soybeans, that we don't have enough soybeans globally to meet demand. There I want a looser stop, because chances are this could be a fairly healthy trend. Then there's also shock fundamentals, things that nobody anticipated that the market reacts to. And then again, I try to take it apart. Is it anticipation? Is it reality, economic reality? So now going back to your question, I kind of think about the logic behind the fundamentals of a particular market. An example would be copper. Copper, China consumes about 48% of copper, global consumption of copper. United States number 2 and Germany's number 3. China consumes enough copper to wrap a copper wire around the world 100 times per day. So we know China's economy is a pretty good barometer, not only in construction, and you use typically in a house in the United States about 400 to 600 pounds of copper, but also industrially, because they have to produce stuff for now people living in the cities. They have more people living in the cities in China now than on the farm. A shift of population greater than the United States in the last 10 years. So they got to build stuff for them. And they also have to build stuff that we buy. So when I look at that market, then I think about how's it going to be used, who's using it, and what is their current environment. So how do I gather that information? Well, one, I've been looking at stock indices and the currencies and interest rates and metals and energy and agricultural markets for many years. So you get a feel for what is typical and what's not typical. And you and I can do that even with price ranges. So when unemployment comes out, what is typical for bonds? What is the clue that you and I could look at? Is the Asia session, if we're looking at futures, is the Asia session more important than what happens in Europe? So I take that into consideration too. What is expected behavior? How is the market behaving? Is it normal, abnormal? And I use news services to help me gather the current fundamentals in a particular part of the world or a particular market space. So it gives me a feel for, all right, is this acting normally? So for example, with crude oil, we have so much supply. Not that it can't change, and it will change maybe at some point. But the dynamics of the market are different. An example of that would be the shale producers of crude oil. When they first started producing shale, I remember, because I deal with some oil companies, and I remember them saying it's got to be about $70 a barrel for them to be profitable. Well, we could get as low as $30 a barrel And those oil shale producers, some of them can be profitable. Depends on their debt load. And, necessity is the mother of all invention. And my father would always say that. And I think it's true in this market example. Drillers became more efficient. They realized what hurt them before and what may be helpful to them now. So they tighten things up and they run more efficiently. So I look at those kind of dynamics to give me a feel, does that price action that you and I are looking at, that human behavior, because that's what you and I see in a chart, I don't care what kind of chart it is really, it's a reflection of the beliefs of all the people who are coming to trade that market.
That's fascinating. There's so much nuance to the futures markets, and each market is a little bit different. And it's incredible. You watch your daily video, in a glance, you get an overview of all of those markets. So Dan, I know you're working on this really interesting project around creating an ETF for diamonds. And I was wondering if you could talk a little bit about that. It sounds like a really interesting project.
Well, it has been an interesting journey, Mike. I have to say that. We've been looking at it, myself and a couple partners, on securitizing diamond in the ETF format, the ETC, a futures contract, options. We have 2 patents on that, a 3rd patent pending on this process of securitizing diamonds. In the past, this is not a new idea, and that people have been trying this for many years. Look at the financial community. They come up with an idea. And the diamond world says, you gotta be kidding me. We're not gonna support that product. Or the diamond industry comes up with an idea. And the financial marketplace says, that's not gonna work in the financial, or the regulator may say, no way, no how. So what we tried to do is a different approach. I'm familiar with the financial side, and so are my partners. Together, we probably have over 125 years of experience in the financial place. So we know the exchanges around the world. We know ETF sponsors, if we're going to start with that product. So we know the financial community. We know what the regulator is going to want to an extent. You don't know until they actually look at it, but we have a feel for what they would want to see. And the index provider that would create a reference index, what kind of data quality they need to create that price reference. And then on the diamond side, and this has been a multi-year process, we've talked with and met with, and we have a good alliance with an entity in the diamond world. See, here's the tricky bit. If you go to a diamond miner, or if you went to a diamond cut and polisher, and by the way, 80% of diamonds are cut and polished in India. If you look at those communities as the only source, then the issue is, from the regulator point of view, could there be manipulation of price data? What you've seen, is it clean? And then how do you verify and certify that these diamonds are what you think they are? And so we have a process that's gone through to make sure that what is standing behind that product, whether it's an ETF, ETC, or a futures contract, is the quality of product that meets that contract specification, which is critical. So all the products that we create, we want to create physically backed product. Exchanges are more comfortable with that. Regulators are more comfortable with that. Institutions are more comfortable with that kind of contract.
Diamonds are one of those things that are steeped in a lot of different cultures. And so there has to be challenges in dealing with those cultural issues.
Diamonds are unique in the sense of where it fits in to culture around the world. One of the reasons why we were looking at diamonds is because it's the last hard asset to be securitized. It has the perception of a holder of value. Now, usually when you and I think about that, we'd say, oh, gold, silver, precious metals are something that's considered to have a storehouse of value. And diamonds have that perception as well, too. All these kind of things are only what the market believes. It's a fascinating thing. We were talking before about soybeans, other things. Those have fundamental reality drivers. When it comes to the holder of value, precious metals, diamonds, it's perception of what that represents. And culturally, where we're seeing changes, an example going back to China. China, in the past, you would have a gold band. China, there's 10 million weddings occurring all the time, and those 10 million weddings, that now the expectation is for a diamond ring. The people we met with in China to talk about this, actually, a number, depending on who you talk to a young man, he would say diamonds are for an investment. If you talk to his potential bride, she would say diamonds are for romance. In our country, in the United States, which is the consumer of the largest amount of polished diamonds, we do, because we've been educated to think that way, that they are a holder of value. So the fact is, they are. What we perceive it to be is the way we treat it, and it's the way it's traded. So it's interesting of how it fits in. I have to tell you, our intent is not to compete with the jewelry store. It's to provide a reference, a value reference that we could use for hedging, that if someone owns gold, they may want to own some exposure to diamonds. In times of uncertainty, that's where you expect capital to flow. And so that's part of our thought process as we looked at that product.
Well, it's an interesting product, and I wish you luck on getting that complete.
Thank you, my friend. I appreciate that.
So Dan, I know you mentioned earlier that you travel all over the world and you're a consultant to hedge funds and prop trading firms and all kinds of industry groups and organizations, but you're also very accessible and you're very good at teaching aspiring traders how to trade and how to get into the market. So for those aspiring traders out there, what advice can you offer them?
Here's where I think I would begin, Mike, if I was looking at this concept of trading, whether you're talking about stocks, futures, or options. For a trader just beginning, where I think they want to begin is the idea of acceptance of risk. Because you've worked hard for this money, and now it's going to be at risk. Once you touch a market, there's going to be risk involved. Will all of your trades make money? No. So you're dealing with this unknown. And for some people, it becomes incredibly uncomfortable. And what results is they freeze or they become over-analytical. They get lost in the analysis, but not the execution, not getting to that next step. So I think it's important to do that, to understand that you're going to have losses, that you need to feel comfortable with accepting that risk. What's fascinating with that, though, is you and I have some control when it comes to how much risk we're going to take. But I think that's an important step that oftentimes gets overstepped. I'm working on this Trading in the Eye of the Storm book, and what I've realized with the number of traders I've worked with over the years, and I've been doing that with institutional traders since about the late 80s, there are some common things. And this concept of risk, I think, is an important one. The next step is to identify the market that you're interested in. Pick something that you find interesting because it motivates you to follow that market. But I'm saying pick one market, pick one stock, pick one futures contract that you find interesting. Follow that market. And you could use options to trade it, depending on your capital. And your trading strategy will help you dictate how much capital you need. It's another area that I find people sometimes struggle with. They have $1,000 in their account and they say, if I could make $5,000 a month, I'd be terrific. Well, you're asking something from your account can't give you. So you want to make sure that your expectations are in line, your output of your business is in line with the amount of capital you have. And the market you're going to trade is going to determine how much exposure you're going to have. Now, on the money managers, if we think about how much exposure, or hedge funds that I've been involved with, we're looking at 1 or 2% of capital. So it depends on how much money you have. It's going to be the appropriate size. Let's say that we have a $100,000 account. If we risk no more than, say, 2% of that $100,000 on any one trade, and we look at our trading strategy, and we've determined that the risk on this trade is $500 a contract. So that means I don't want to risk more than $2,000. My risk per contract is $500. The maximum I can trade is 4 contracts, right? 4 times $500 or $2,000. Doesn't mean I have to trade all 4, but that would be the maximum exposure. So that would be an example of where you and I want to begin in thinking of how much do I put towards a trade. Now let's talk about the trading strategy. I think in the trading strategy, what's critical is not only trade entry and trade exit. And usually people focus on that profit exit. They say, look how much I could make. If I could make $100, but I'm risking $500 or I'm risking $5,000, is that something I can handle? Is that appropriate for my account? And we also need this, you could make an argument, how often does that happen? Is it 50% of the time? Is it 10% of the time, 5% of the time that you would lose that money? So we got to have that balance between risk and reward. So it's important not only to look at trade entry and trade exit with a profit, but also with a loss. And what I look at when it comes to the expectation for profit or expectation for loss is the characteristic of the market that I'm trading. Every market has its own volatility characteristics, for example. So whatever the technical signal or however you're generating that buy or sell signal, you want to look at what happens during the life of this trade. What is the potential profit? What is the range of profit? What is the range of loss? And what I mean by range, I mean what is the minimum to maximum? And we want to focus on those outer layers. So for example, in the risk, my maximum risk based upon how this market has performed. And you get the tools with TradeStation to do that. So we can now look at that maximum risk to help me determine where I should be putting my stop. I don't trade without stops. So I think that's important to look at. I think it's also important to look at how long do you hold that position, because patience is such a critical part of trading. We put a trade on, it's, oh my God, it's not moving. We get out and, oh my God, it just moved. I can't believe it. It always does that. So if I put the trade on and I know if I put it on 11 o'clock, the market has a tendency to go sideways now. So I'm going to have to be patient. If this trade takes, an hour to mature, well, then I need to give it an hour to at least find out if it's going to be a profit or a loss. So patience for us to let the trade develop, patience to put the trade on and let it mature, I think are important characteristics. We should know those parameters so we have an idea of how patient should I be. If it should happen within an hour, if I'm day trading and it hasn't happened, well, I'm 2 hours into it, it's probably telling me, Dan, this isn't going to work. Now you're in a hope trade. So I want tight parameters around it. I do that with options. I will buy an option, and I like to sell premium too, but I will buy an option, but I want the expiration beyond the current. I want delta near 100. If this trade's going to work, it should work within the next 2 to 5 days. If it doesn't, I give it the big adios and look for another trade. I take that money and find something else. So I think it's important to get those kind of parameters around your trading decision, because without them, I truly believe it's one of the causes behind hesitation. Why does someone hesitate to do something? They hesitate because they're not sure, and there's a high degree of discomfort. So it freezes them to take the trade. Then it ends up being a good trade, and they go, oh my gosh, I can't believe it. Well, if you're confident, if you're comfortable with that trading strategy, you don't hesitate. Professional traders don't hesitate. If you feel hesitation, you're not ready to put that trade on. Go back, check your variables again to make sure that they're showing you what you think they should show you to get ready to take that trade. So again, hesitation, then you're not ready to do it. And you know something too, Mike? Time is such an important parameter here for someone starting out. If somebody's saying to you, oh my God, you got to get in this market, it's never going to be like this again, that's not true. I have heard that for over 30 years. There's always an opportunity in the market. Always in some market, something's moving. So you want to be patient with that. Be patient with yourself. Take your time to learn that market, to learn your technique. And then when you have that confidence and comfort, then you can put that trade on. And, again, as we were talking about, those answers to those questions, I think is what, TradeStation can provide. And I imagine people listening to this are probably TradeStation clients. So take advantage of the power of that program. Take advantage of all the things, Mike, that you put together and TradeStation puts together on education. I think those are some things that it's important that we want to keep in mind. If we're just starting out or if we're struggling a bit, to maybe take a moment, step back, and rethink some of these issues and ideas.
Yeah, I think that's all really good advice. And I think you really pegged one of the problems that a lot of aspiring traders has is that hesitation. And really that hesitation is just born in the fact that they are not confident in the market that they're trading yet. And they can become confident just by doing a little bit of research, by watching some webinars and getting some education.
I think so, Mike. If someone feels that, it is important to have that comfort. You can have that confidence.
Well, again, I want to thank Dan Gramza for spending this time with us today. Dan, this was really great. Thanks for spending this time.
Oh, my pleasure, Mike.
You can learn more about Dan at dangramza.com, where he has his daily futures market outlook. Well, thanks everybody for listening, and be sure to tune in and subscribe to more of our TradeStation podcasts. And of course, don't forget to visit our website at tradestation.com to learn more about our outstanding educational resources and online brokerage services. The preceding podcast was for educational purposes only. All of the symbols and trading ideas discussed by the instructors and guests were for educational purposes and not recommendations. Active trading is not suitable for everyone. Options trading carries a high degree of risk. You can find the characteristic and risks of standardized options disclosure and additional disclosures on the TradeStation website.